Hello everyone, welcome to the 120th episode of me learning how to trade in Forex. So in the last episode, we went through the last, lesson in setting the stop losses, which is 3 rules to follow when using stop loss orders. So there's 2 ways to set stop losses. One is automatically, and there's another through mental, aka manually. Basically, if you can do it automatically, because you don't want to try to think about what to do or where to put your stop loss during when the market's moving and stuff, because then your emotions come into play and then that just brings you down to another whole, I don't know, somewhere where you're not meant to be, basically. So you don't want your emotions to dictate how you would trade, basically. So so especially the more inexperienced traders often question themselves and lose that objectivity when the pain of losing kicks in and brings the negative thoughts. So wrong, if the market's reached a stop, your reason for the trade is no longer valid and it's time to close it out. No questions asked. I will not widen my stop. New Forex traders should always use limit orders to automatically close out a losing trade at a predetermined levels. Of course, the more trades and experience you have, the more you'll hopefully have a better understanding of the market behavior, your methods, and the more disciplined you'll be. Only then would mental stops be okay to use, but still highly recommend using the automatic stops for the majority of your trades. 3 rules for setting stop losses. Rule number 1, don't let emotions be the reason you move your stop. Rule number 2, do trail stop. And rule number 3, don't widen your stop. Do not widen your stop. So that's that. And now we're on to summary, setting stops. Date is the 29th. So setting stops, well, there you have it, our awesome primer to setting stop losses. Now let's review the things you need to remember about stop losses. Find a broker that allows you to trade position sizes that suits the size of your capital and risk management rules. So find a broker which allows you to trade position sizes that suits the size of your capital and risk management rules. We use the word predetermined a lot in this lesson because you should always know when to get out before you open a position. Always know when to get out. Before you open a position. Before you open a position. So buy, stop loss order, avoided loss. Because if you didn't put a stop loss order there, then you would have gone whoop whoop, see you later, and that would have been really bad. So once you are already in trade and it's turned into a loser, you lose the ability to make a decision to exit the trade with a clear head. That could be very bad for your account balance. Set stops to the current market environment, framework, or trading method. Set stops to the current market environment, framework, or trading method. Do not set your exit levels to how much you're willing to lose. Do not set your exit levels to how much you're willing to lose. The market does not know how much you have or how much you're willing to lose. Quite frankly, it doesn't care. Find the stop levels that prove your trade wrong first, and then manage your position size accordingly. So find the stop levels that prove your trade wrong. Find the stop levels that prove your trade wrong first, and then manage your position size according to it. Find the stop levels which prove your position size, which prove your trade wrong first, and then calculate your position size, and then manage your position size according to it. Find the stop levels that prove your trade wrong first, and then manage your position size according to it, and then manage your position size according to it. This is worth repeating. Find the stop levels that prove your trade wrong first, and then manage your position size according to it. Use limit orders to close out your trades. Mental stops should only be used by those with a bazillion trades recorded in their journal, aka probably never. So use limit orders to close out your trades. Use limit orders to close out your trade. Even then, limit orders are still the way to go. Emotionally unbiased and can be automatically executed while you're taking in some sun on the beach and sipping on virgin margaritas. Only move your stop in the direction of your profit target. Only move your stop in the direction of your profit target. Trailing stops are good, widening stops are very, very bad. Stops are good, widening stops are bad. Like anything else in trading, setting stop losses is a science and an art. Markets are dynamic, volatility is volatile, and a rule or condition that works today may not work tomorrow. If you continually practice the correct way to set stops, record and review your thought processes and trade outcomes in your journal, then you'll be one step closer to becoming a professional risk manager. I removed my stop loss, and now he's broke. Quiz time. Setting stop losses. How much do you know about setting stop losses? Take this quiz to find out. Let's go. Your stop loss should be the something of your trade idea. Invalidation point of your trade idea. Your stop loss point should be the invalidation point of your trading idea. When price hits this point, it should signal to you it's time to get out, buddy. Which of the following is not one of the 4 methods of setting stops? Liquidity. There are 4 methods of setting stops: percentage stop, volatility stop, chart stop, and time stop. The equity stop is also known as the percentage stop. The equity stop is also known as percentage stop. You should always base your stop on your market environment, your system rules. You should always set your stop according to the market environment or your system rules, and not how much you want to lose. The danger of using equity stops is that you are forced to set your stop at an arbitrary price. The danger of using equity stops is that you are forced to set your stop at an arbitrary price. Okay. Using a chart stop involves setting your stop above or below support and resistance levels. Using a chart stop involves setting your stop above or below support and resistance levels. When your trade idea is invalidated, you should exit your trades. When your trade idea is invalidated, you should exit your trade. This refers to the distance a market can potentially move over a given period of time. Volatility. Volatility is the amount a market can potentially move over a given time. Which of the following is not an indicator which can help you gauge volatility? The stochastic. One way to measure volatility is by using Bollinger Bands. Another way to find the average volatility is using the average true range indicator. If you're using Bollinger Bands to set your stop, you would ideally place your stop beyond the bands. When measuring volatility is by using Bollinger Bands. When measuring volatility is by using Bollinger Bands, okay. Simply set your stop beyond the bands. If price hits this point, it means volatility is picking up and a breakout could be in play. Time stops are based on a predetermined period of time. Time stops are stops you set based on the predetermined time in a trade. Time stops can help you avoid tying up margin in dead trades. Time stops can help you avoid tying up margin in dead trades, which could be costing you an opportunity, another great trade setup somewhere else. To give your trade enough room to breathe and avoid placing stops too tight, you should account for the pair's average volatility. Always remember to account for the pair's volatility and the fact that it could dilly-dally around your entry point for a little bit before continuing in a particular direction. When setting stops, you should decide where to place your stop first, then compute the position size. This is probably the first one. Using position sizing to calculate how far your stop should be has nothing to do with how the market is. What? Using position sizing to calculate how far your stop should be. I think that should mean should have nothing to do with how the market is behaving. You should decide where to place your stops first before calculating your position sizes. The general rule of thumb is to set your stop as far from your entry point as possible. Set your stop as far from your entry point as your target profit. Set your stop closer to the entry point. Setting stops too far increases the amount of pips you trade. Your trade needs to move in your favor to make the trade worth the risk. The general rule of thumb is to place stops closer to entry than profit targets. When going short, it's a good idea to find the next potential resistance level and set your stop. If you're going short, then you want the price to go down, so you want to set your stop above the resistance. If you're going short, you can find out where the next resistance level above your entry is and put your stop around there. Which of the following is not a way of executing stops? Using a margin stop. There are two ways to execute stops if the market goes against you. One is by using an automatic stop, and another through a mental stop. Trailing your stop involves moving your stop in the direction of a winning trade. Trailing your stop means moving it in the direction of a winning trade. This locks in profit and manages your risk if you add more units to your open position. When should you widen your stop? Never. Don't widen your stop. Increasing your stop will only increase your risk and the amount you will lose. 19. Very nice. Very nice. So, scaling in and out of positions. In and out of. So, now that you know how to set proper stops and calculate correct position size, here's a lesson on how you can get a little creative in your trading. For those trading multiple position sizes, you can get really flexible and creative on how you manage your risk by scaling in and out of your positions. So, what is scaling? What is scaling and why would you use it? Scaling in doesn't mean weighing yourself before, during and after a trade, though it doesn't hurt to monitor that tool. 2. Scaling basically means adding or removing units from original open position. Basically means adding or removing units from your original open position. Scaling can help you to adjust your overall risk, lock in profits, or maximize your profit potential. Scaling can help adjusting overall risk, lock in profits, or maximize profit potential. Of course, when you add or remove from your position, there are potential downsides to be aware of as well. In the following lessons, we'll teach you all about the benefits and drawbacks of scaling in and out of trades. We'll teach you the correct way to do this so that you don't go crazy because you took on too much risk and blew out your account. Benefits of scaling. The biggest benefit is a psychological one. Scaling in and out of position takes away the need to be absolutely perfect in your entry or exit. Or out of a trade. And out of your position removes the need what is going on? The need to be absolutely perfect in your entry or exit. I'm scaling in the pound nicely. No one can consistently predict price action or the exact turning point of a market. It's way too difficult to keep expecting to get the best entry possible all the time. You're setting yourself up for a lot of heartaches. The best we can do is identify an area of potential support resistance, reversal, momentum change, breakout, etc. You can enter your position in bits and pieces around those areas and or take your trade off at different levels to lock in profits. How much easier would it be on you psychologically if you didn't have to accurately pinpoint exactly where to get in or out of a market? A lot easier, right? Plus you don't have to be accurate as a sniper and catch a move from its inflection point, all big words, to grab some pips. I'm guessing inflection means its turning point. It also takes a lot of weight off your shoulders anytime you can reduce risk, right? How about locking in profits? Properly executed with a trading stop, scaling out of winning trades can help you protect your profits, just in case price suddenly reverses. Scaling out of winning positions can help you protect your profits. Just in case the price suddenly reverses. Finally, if you add more to your open position and the market continues to go your way, your bigger position size will increase the amount you will make for every pip. Drawbacks of scaling. The major drawback of scaling is when you add more to your position. Can anyone guess what the drawback is? You got it. You increase your overall risk. Remember, traders are risk managers first, and if they're done incorrectly, scaling in can wipe out your accounts. Lucky for you, we'll explain how to safely add to an open position. The second drawback is when you remove portions of your open position, you reduce your maximum profit potential. Your maximum potential profit. Who wants to do that? Well, in markets as fast as and dynamic as the foreign exchange market, it may benefit you to reduce your risk and take some off the table. In the next few sections, we'll go through some basic examples of the babypips.com way to scale in or out of a trade. Major drawback of scaling in is an increase in the overall risk. Scaling out of positions reduces maximum potential profit. So, that's not how you write, how to scale out of positions. As mentioned earlier, scaling out has the obvious benefit of reducing your risk as you're taking away exposure to the markets. whether you're in a winning or losing position. When use of trailing stops, there is also the benefit of locking in profits and creating a nearly risk-free trade. We'll go through a trade example to show you how this can be done. Example, scaling out of Euro USD. Let's say you have a $10,000 account and you shorted 10,000 units of Euro USD at 1.3. You place your stop at 1.31 and your profit target is 300 pips below your entry at 1.27. With 10k units of Euro USD, pip value of this position is $1 and a stop of 100 pips, your total risk is $100 or 1% of your account. A few days later, the Euro USD has moved lower to 1.29 or 100 pips in your favour. This means you have a total profit of $100 or a 1% gain. All of a sudden, the Fed releases dovish comments that may weaken the USD in the short term. You think to yourself, this may bring dollar sellers back into the market. I don't know if Euro USD will keep going down. I should lock in some profits. You decide to close half your position by buying 5k units of Euro USD at the current exchange rate of 1.29. This locks in $50 worth of profit into your account at 5,000 units of Euro USD. 1 pip is valued at 0.5 dollars, and you have closed a profit of 100 pips, which is 100 pips times 0.5 dollars, so that's $50. This leaves you with an open position of 5,000 units short Euro USD at 1.3. From here, you can adjust your stop to break even 1.3 to create a risk-free trade. If the pair moves back higher and triggers your adjusted stop at 1.3, then you close out the remaining position with no loss, and if it moves lower, then you can just ride the trade to more profits. Obviously, the trade-off for taking off some on the table is that your original max profit is reduced. Now, if Euro USD ended up falling to 1.27 and you had caught the 300 pip move of a 10k unit position of Euro USD, then your profit would be $300. Instead, you close the 5k units at a 100 pip gain for $50, and then you close your remaining 5k at a 300 pip gain for $150 gain, because $0.5 per pip times by 300 pips is $150. Together, this makes a $200 gain versus your original $300 maximum profit. Here's a chart to show you to help you visualize the different times when to scale out. Ignore the dragon trying to bring his scales out. Stop loss at 1.3, that's why we set it. Sell at 10k units at 1.3. Market price action goes down. We've bought it back here again, so this is our profit for your first half. We still have this position open, just half of it, so 5k position open, and then price drops all the way back to our profit target, so our profit would then be this bit here, so from here to here. The decision to take some profit off the table is always up to you. You just have to weigh the pros and cons. In this example, the trade-off is a better profit versus the peace of mind of a smaller lock-in profit and creating a risk-free trade. Which is better for you? 50% more profit or being able to better sleep at night? I think being able to better sleep at night is a better choice. Remember, there is a possibility of the market moving beyond your profit target and adding more bling bling to your accounts. There's always much to consider when adjusting trades, and with practice over many trades, you'll find a process of taking off trades most comfortable to you. Next up, we'll teach you how to scale into positions. You may be asking why would I want to add scale into a trade? Scaling into positions, if done correctly, will give you the benefit of increasing your max profit. But as they say, higher reward means higher risk. If done incorrectly, the value of your account could drop faster than you can even think about clicking the close button of your trade. Before you know it, you'll be staring at your computer screen, eyes wide open, and watching your account get a margin called. Now, we don't want that to happen, right? So pay attention in class. What separates the correct way from the incorrect way is the profitability of your open position when you add, how much you add, and how you adjust your stops. What separates the correct way to correct and the incorrect way to scale in and out of a trade is the profitability of your open positions when you add, how much you add, and how you adjust your stops. In the next two sections, we'll teach you two potential scenarios for scaling into a position. Since traders are risk managers first, we'll also touch upon the no-nos of adding to an open position. So, how to scale in positions. So, how to scale in positions. In the previous lesson we discussed how to scale out of a trade. Now we show you how to scale in a trade. The first scenario, actually, just thought of this. Visual representation. Actually, like that. How to scale in positions. In the previous lesson we discussed how to scale out of a trade. Now we'll show you how to scale in a trade. The first scenario we'll cover involves adding to your position when your trade is going against you. Adding to your positions when your trade is going against you. Adding more units to a losing position is the tricky business, and in our view it pretty much should never ever be done by a new trader. If your trade is clearly a loser, why add more and lose more? It doesn't make any sense, right? Now we say pretty much because if you can add to a losing position, and if the combination of risk of your original position and the risk of your new position stays within your risk comfort level, then it is okay to do so. What? Now we say pretty much because if you can add to a losing position, and if the combination of risk of your original position and the risk of your new position stays within your risk comfort level, then it is okay to do so. To make this happen, a certain set of rules has to be followed to make this trade adjustment safe. Here are the rules. You can add to your position when your trade is going against you. However, to make this happen, these rules must be followed. A stop loss is necessary and must be followed. The levels of position entry must be pre-planned before the trade is put on. The levels of position entry must be pre-planned before the trade was put on. The levels of position entry must be pre-planned before the trade is put on. Position sizes must be pre-calculated and the total risk of the combined position is still within your risk comfort level. Must be pre-calculated and the total risk of the combined positions is still within your risk comfort level. Okay, trade example. Let's take a look at a simple trade example of how to do this. So, areas of consolidation can be great levels to play a swing back into a trend, but which level would you enter? From the chart above, we can see that the pair moved lower from 1.32, so here, and then the market saw a bit of consolidation between 1.29 and 1.3 before breaking lower. After bottoming out around 1.27 to 1.28, the pair retraced the area of recent consolidations up to here. Now let's say you think that the pair will return to the downside, but you're not confident of picking an exact turning point. Here are a few scenarios on how you could enter the trade. Entry option number 1. Short at the broken support turn resistance level, so this one here, of 1.29, the bottom of the consolidation level. The downside of entering at 1.29 is that the pair may move higher and you could have potentially gotten in at a better place. May move higher. So we think that the price is going to continue to go down again. So if you enter here, the downside is that the price could go up all the way up here, and then it will drop back again. So we're losing out on this much, however much it goes up, profit basically. Oh wait, let me just see. So few methods on how to enter the trade. Entry option 1. Short at the broken support turned resistance level of 1.29, which is the bottom of the consolidation level. Downside of this is that the price may move higher, which is which leads to which potentially leads to reduced profit. Entry option 2. Wait until the pair reaches the top of the consolidation area, so at here, which also happens to be a psychologically significant level, potentially greater resistance level. But if you do wait to see if the market reaches 1.3, then you run the risk of market not making it all the way up there and it drops back down lower, and you miss the return to a downtrend. Wait until the currency pair reaches the top of the consolidation area at 1.3. However, the market may not make it all the way up there. However, the market may not make it. However, the market may not make it. However, the market may not make it all the way up there. Might. Let's just call it might. Might not make it all the way up there. Before dropping back down lower. Therefore, you would miss the return to downtrend. Entry option 3. You can wait until the pair tests the potential resistance area. So this bit here. And then moves back below the 1.29 into a downtrend before entering. This is probably the most conservative play, as you get a confirmation that sellers are back in control, but then again you miss out on getting in a downtrend at a better price. So wait until the pair tests the potential resistance area. So after the pair's gone like duh 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 duh, and then after it's moved down, then you get in on the trade. Then moves back below 0.29 into the downtrend before entering. This is probably the most conservative play. Probably the most conservative plan. Due to the confirmation that sellers are back in control. However, you still miss out on getting in the downtrends at a better price. Entry option 4. What to do? Why not enter at both 1.29 and 3? So 1.29 and 3. That's doable, right? Sure it is, just as long as you write all this down before the trade and follow the plan. Enter at both 1.29 and 1.3. Just as long as you write all this down before the trade and follow the plan. So, determine trade invalidation points. Let's determine our stop level. For simplicity, let's say you pick 1.31 as a level that signals you are wrong. So somewhere above here, and then the market will continue higher. This is where you exit your trade. So to do entry option 4, follow the steps to do entry option 4. Determine trade invalidation point, stop loss. Let's determine our stop level. For simplicity, let's say you pick 1.31 as a level that signals you are wrong, and then the market will continue higher. This is where you exit your trade. Say it's 1.31. Determine entry levels. Secondly, let's determine our entry levels. There was support and resistance at both 1.29 and 1.3. So we can see that because it's over here. So you add positions there. There was support resistance at both 1.29 and 1.3, so you add positions there. Okay. Nice repeat. There was support resistance at both 1.29 and 1.3. So add positions there. Determine position sizes. Third, we'll calculate the correct position sizes to stay within the comfort risk level. The correct position sizes to stay within the comfort risk level. Let's say you have a $5,000 account and you only want to risk 2%. That means you're comfortable risking $100 because it's 2% of 5,000 on this trade. Whoa, but in the previous lesson, didn't they say not to base it on how much you're willing to lose and instead base it on the market environment and stuff like that? So this is what you're not meant to do, isn't it? Just saying how much you want to lose because it's just an arbitrary price. So yeah, you're not meant to do that. Trade setup. Here's one way to set up this trade. Short 2,500 units of EUR/USD at 1.29. According to our pip value calculator, so remember it's where is it? This formula here, position size, all that. According to our pip value calculator, 2,500 units of EUR/USD means your value per pip movement is $0.25. With your stop at 1.31, you have a 200 pip stop on this position. And if it hits your stop, that is a $50 loss, value per pip movement 0.25 times the stop loss of 200 pips. Short 5,000 units of EUR/USD at 1.3. Again, according to our pip value calculator, 5,000 units of EUR/USD means your value per pip movement is $50 or $0.5. Yep. With your stop at 1.31, you have a 100 pip stop on this position. And if it hits your stop, that is a $50 loss. Value per pip movement is $0.5 times my stop loss of 200 pips. Combined, this is the $100 loss if you're stopped out. Yeah, pretty easy, right? We have created, combined, this is a $100 loss if you're stopped out. But what is the potential profits though? Pretty easy, right? We have created a trade where we can enter 1.29, and even if the market went higher and created a losing position, we can enter another position and stay safely within the normal risk parameters. And just in case you're wondering, the combination of the two trades created a short position of 7,500 units of EUR/USD, with an average price of 1.2966 and a stop loss spread of 134 pips. If the market went down after both positions were triggered, then a 1-to-1 reward to risk profit $100 will be achieved if the market hit 1.2832. Right, okay. Because the bulk of your position was entered at the better price of 1.3, so the top one, EUR/USD doesn't have to fall too far from the resistance area to make a great profit. Very nice. $50 loss, $50 loss. So combined $100 loss. Oh, I see. So if it hits that and then goes down, then you're not really losing anything because you haven't even entered the trade here, so you all profit now basically. But then if it went past this position and it hits that and then it goes down, you're still good to go because what is it? If you get stopped, because if it hits that and it goes down, then you're still making a profit technically because you haven't hit your stop. and the majority of your position size is at the top bit anyway, so there's more profits to be made if you shorted at a higher level. So yeah, it's a good situation. Didn't matter if the trade went down at this level or at this level, there'd still be profit either way. As long as it doesn't hit the stop loss level here, then you're good. Yeah. E50. Yeah, okay. And it's the same wait, so if it goes up, hits a stop. Yeah, combined $100 loss, because then it hits your position there, and then that's $50 from here to here, and then that's another $50 from here to here, so plus two together, $100. Yeah, okay, I see. Yeah. Okay. Oh, damn. I don't need to make any notes from this, right? I'll take this photo instead. Okay, good. I'm going to leave this episode here then. So in the next video, we're going to move on to the how to add to winning positions. So thank you all for watching, and I will see you guys in the next video. Bye!